So the three biggest dangers in retirement are number one, taxes, number two, inflation, and number three, market volatility. So as we work through this, I'm going to be tackling those opportunities to make sure that you're really comfortable with what's going on, right? So danger number one, right? You're handing off your financial future to the government through your IRAs and your 401ks. Again, I know, you've been told to do it. I was told to do it. I fell for the trap a long time, but it's a reason why you're listening to me right now, right? This is a trap. So what happens is that you're actually using this tax deferred money, you're putting it into this stock market and things like that, and the government is waiting. They're waiting to get their paycheck, right? And you're subject to it. So who controls the split of the ownership? That's the key thing that people need to understand. So it's not like a firm agreement where they're saying, hey, you know what, Moses, when you retire, we'll take 10%. Like literally, it's subject to their approval how much money they're going to take from your retirement. Like that doesn't sound like a good deal to me, right? The secret to this is that you can take control back, and we'll walk through those strategies, right? So to have a firm understanding on what can be taxed, I wanted to really break this down on this slide for you, right? So there's three types of income that are subject to taxes. The first is the most common one, is earned income, and that is like salaries and wages, right? Then you have passive income, which can be rents. Many of you might know me as Moses the Mentor. I am a rental property investor, so I know that very well. And then you have portfolio. Portfolio income is income that comes from owning investments like interest or dividends or, the sales, right? So let me ask you this. Let's just take a moment. What future tax rates do you think we will likely have? Will you say A for lower, B for the same, or I might give you the answer? and this is just not me trying to make this up. This is just simply looking at the trajectory, right? So I think when I ask people this question, I've really never heard someone say lower. I've never heard someone say lower or the same. Most people say, I would say 99% of people will say, oh yeah, it's probably going to be higher, right? So if you know that, when you do something different, all right. The way that the government actually raises your taxes, they do it in three ways. And I think when people hear raise taxes, they think of only the tax rate. Like, oh, it goes from 20% to 30% to 30% to 40%. But they actually raise taxes on us in three ways. And I want to break that down. So the first way, again, is raising the tax rate. The second way is by raising the tax thresholds, which is a sneaky one, a very sneaky one. And then the third way is eliminating deductions. Okay. All right. So when you look at this graph here, this graph shows the path we've had since we've implemented an income tax, which was in 1913, which started out at 7%. But as you can see here, that 7% has come a long way to 37%, which we are currently at this video. But you can notice here that at some point we reached the peak of 94%. So believe it or not, as much as we complain about taxes today, at some point, the highest tax bracket was a 94% tax bracket. Okay. So you see, we've had some ups and downs and we've been trending downward, and we've kind of, been at this 37% mark for some time now. And they, at the time of this video was recently passed. The Trump tax rate was locked in, right? Locked in for now until someone can come in and change it. But when you look at this, it's a little telling, right? Because again, we at times assume that we're overtaxed. And that's relative. It's subject to, what you believe, right? But when you look at the history, we're actually in a lower taxed environment, right? You look at I was born in 83, and we're pretty much where we were at 83. But right before that, you can see taxes were pretty crazy, right? So knowing that we're in a lower tax environment today, what would make you think that we would be in a lower tax environment in the future? That's what I would want to know. Okay. So when you look at lower tax thresholds, now this is the one that's sneaky. This is the sneaky one, right? Because people become obsessed with the rate. This example shows that in 1917, someone who made $20,000, that was the equivalent of today, of roughly today's dollars, of $511,400. That person would have been subject to a 12% tax rate. Okay. Now, in 2025, that $500,000, that person would be subject to a 37% tax rate. That is the same monies, the same income equivalent. At the time of 1917, they had a rate of 12%, but it's triple the amount today for someone who has 500,000 in income. That's huge. Okay. So you can't go dollar for dollar. You got to look at it as far as inflation adjusted income. So again, 20,000 is pennies these days, but 20,000 was over $500,000 in 1917. And that person had the privilege of having a tax rate of 12%, whereas today it's 3 times as much. That's huge. The last way that they actually impact us from a tax perspective is that they tackle our deductions, right? And what people don't understand is that even though this notion that your tax rate, that your taxable income is lower when you retire, it's really not true. It can almost certainly be not true, right? Because you typically lose these 3 deductions when you're in retirement. Mortgage interest, because people strive to pay off their home, right? They're like, oh yes, I'm in retirement, I paid off my home. So what happens is, yes, you don't have a mortgage, but your biggest tax deduction, which was your mortgage interest, is now removed. No one told you that, right? Then children. Some people are having children later in life, so it might not always impact people, but for the most part, when people hit retirement, they don't have underage children, or they don't have children that they can claim as a dependent. So what does that do? That remove all child tax credits. Wow, I didn't think about that. Got you. And then the last one is, you've been so dependent over the years, contributing to an IRA or 401k. But now, since you're not contributing anymore, those contributions, those tax credits that you were getting, you don't get those anymore. So now when people tell you that you're going to be at a lower tax bracket in retirement, it's not always the case, because you want to still maintain a high level of income so you can enjoy your retirement, right? But you lose so many deductions. So you don't want to play this tax game when you hit retirement. You want to be able to chill on the beach, chill with your grandchildren, do valuable work that's not, income dependent. You can volunteer, do whatever you want to do, travel the world. The last thing you want to worry about is paying unnecessary taxes. Okay. So this chart right here kind of just shows you that, if someone invested $10,000 a year for 30 years, you can see, the account balance will grow, but you see that sneaky deferred tax bucket that's there. So this $1 million is not really their $1 million. Whereas if you were to put it in an IUL, where you're truly putting 10,000 after-tax dollars in there, there's no sneaky tax bucket that's there where the government will take a share. You would simply grow your $10,000 a year, and at that point, it doesn't matter what the tax rate is. That entire $1 million is 100% yours. Okay. Then there's something called RMDs, which is a required minimum distribution, right? And what I teach my clients to do is to do a strategic rollout. right? So we're going to talk a little bit about what that is. So if you're at the point where you're at retirement already and you're currently tapping into your investment, your 401k tax deferred IRA dollars, you don't have to be subject to that. You can go through a process to move that money or a portion of that money into an IUL with a strategic rollout. So this is John Smith. Okay. He's age 62, and he would have to do required minimum distributions at age 72. Okay. His current IRA 401k balance is $1.9 million. Again, sounds great, right? His projected future growth is 7%. The problem is that $1.9 million is not his. A portion of that, a good portion of that, an undetermined portion of that belongs to the government, right? So John and I had a conversation, and John would like to, bring some certainty to his future, and we want to roll that money or as much as that money into an IUL. So we spoke to having a conversation with John, and we're going to do that, right? So when you look at the taxable bucket, his 401k is 1.9 million. We decided that, hey, let's go ahead and just pay the taxes now. His tax rate was, let's look at that. That's, 20% in this example. So 200,000 gross withdrawal means he would get 160,000 net, and we would put 160,000 into his IUL for the next 5 years. Now that 160,000 times 5 will compound, and that money will grow tax-free, so that by the time he's 72, he doesn't have to worry about RMDs, required minimum distributions, or anything like that. His money is growing at an after-tax basis, and it's completely tax-free, penalty-free. So if you're watching this, just know that if you're in retirement or really close to retirement, don't feel like it's the end of the world. We can actually roll out those dollars. This is just an example of how you would do it, but your situation might call for more or less. Either way, I can help you out. So in this example here, though, just to sum it up, if Mr. John here, if he went ahead and just took out his required minimum distributions every year, from time he was 72, he would go ahead and start taking this money out, and he would only net $163,742 versus actually going the route of a max funded IUL, where he would actually be able to net $233,622. And this is all tax-free. This is all tax-free, people. It's a big difference. So we need to get out of that tax deferred bucket as soon as possible. And I can show you that with all certainty. So again, this is just more of just a year over year. So the RMD versus the max funded IUL, you can see here at 70 through 75, if he were to take out the same amount of dollars and contribute the same amount of dollars, he would have, $1.4 million in total income versus 551,000 from an RMD, right? Again, when you have money in a tax deferred account, do not look at that. That's like having a paycheck. Or that's like having a salary, and you say, hey, your salary is 100,000, and you start making decisions based off 100,000. No, you would know, okay, I have Social Security, I have Medicare that comes out, I have state taxes, I have city taxes, maybe I have federal taxes. You cannot look at your 401k and IRA as net. It is not. So why have your money in an actual account giving you false hope? And that's exactly what it is, false hope. So danger number 2 is inflation, right? So inflation in the sequence of returns. This is running out of money during retirement, which is a huge fear. And especially since that we have the blessings of advanced medicine and people are living longer, right? I think the largest population growth is in people who are 100. You know what I'm saying? So it's more people growing at that rate than not. So we need to have strategies, retirement planning strategies that will help us live comfortably beyond 100. I mean, I know it sounds crazy, but that is becoming more and more the case, right? So we cannot run out of money. So let's talk about that. So we need to understand these two things. So why am I saving my money? And why am I growing my money? Right? Those two questions are key. Why are you saving it? Because you want to make sure that when you stop working one day, that you have money that you can live off. And why am I growing my money? Is because of inflation. If everything stayed the same price, you wouldn't have to worry about how much your rate of return is. You'll be like, okay, it's 2025 and a loaf of bread is $2 and it'll be $2 in 2075. We all know that's not true. Inflation is happening in the background, right? So you have to have a rate of return that beats inflation. So you have to focus on these objectives when you're making these decisions, right? So the key is focusing on the right thing. So all those activities you're doing leading up to retirement is really boiling down to this part right here, which is when you distribute the money. You want the money to be there, and you want the money to be have the money to have grown to accommodate any inflation over that time period, right? So distribution is the key part. So you want to have the largest account balance possible, right? And common investment kind of guides always mention something about a 4% rule, right? So you might have heard of that. The problem is that after taxes, when you take 4% of your account balance, after taxes, you're really only getting about 2.64% of your money, okay? Whereas the goal is to generate as much of that income over time, and you really would like to access even more of that money, which would probably be more like a 6 to 10% payout, and that would be tax-free if you have an IUL. So do you want to live off 2.64% of your money, or would you rather be able to comfortably pull out 6% or even up to 10% of your money tax-free in an IUL? I think the answer is pretty clear, okay? When you have traditional retirement accounts, it's focused more on how much money do I need in my accounts, and it runs more like a battery. Whereas when you have an IUL, it's more like a generator, because it focuses on how much money can my account send me every month, right? So on the front end, again, the battery it gets to a point where it gets full, and then it just drains over time. And what do you have to do? You have to replace it. A generator is completely different. It's making sure that when you have those spurts of no power, that you stay whole. And I love my generator. I got a Generac. I love it. I absolutely love it, right? So that's the way you got to look at it. So let me ask you this question. I'm from the city, so I've never done this personally, but conceptually I get it. If you were a farmer and you had the choice to pay tax on the seed or the harvest, which one would you prefer? Okay. I think I know your answer. You would probably, I think 99% of you would want to pay on the seed. But we don't do that when we put our money in IRAs and 401ks. We essentially say, no, 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 no on the seed, and we wait till it matures and grows and compounds, and we say, okay, well, now you can have it. Doesn't make sense. It doesn't make sense, guys. The next danger is the best thing to eliminate from your financial strategy to get ahead really is to eliminate the losses, right? So the stock market, the reason why people invest in the stock market is because the potential of gains. But people hate talking about the losses, but the losses absolutely are a reality. The losses happen, right? And all the people tell you in the traditional finance world is that don't worry about it. The market will recover. And we're going to talk about those dangers of having that mindset. So Warren Buffett is my guy. Someone that I've read a lot of his books. I admire his investment strategy, his approach, and he has two rules. The first rule is don't lose money. And the second rule is don't forget rule number one. So, you can't lose money. So let's look at this example. And this is why people always get this wrong. So let's just say the market went up 50%. year one, and then it went down 50% year two, and then it went back up 50% year three, and then it went down 50% year four. Most people I speak to, even certified financial professionals, will tell you were flat, that you're at a 0% rate of return. And maybe you think that way. Maybe you do. But this is why I'm here to help you. You would be wrong. That is not how it works. So on this slide, whereas people think that the average rate of return in this example would be 0, your actual rate of return would be a negative 43.75%. And this is why. When year one, you had $100,000 and it went up to $150,000. Great job. 50% return is amazing. The problem is that the market dropped 50% the next year. So that 50% drop is not coming off of 100,000. It's now coming across, going to impact your 150,000. So a 50% drop on 150,000 is 75,000 all day. Okay. So 150 now turns into 75,000. But great news, it went up 50% because the market always rebounds, right? Yeah, we always bounce back. Oh, but it's 50% on 75,000, not 50% on 150,000. So that now puts me up to $112,000, 500. Wow, this doesn't look good. Then we had another 50% drop. So now 50% off of 112,500, and that drops you to 56,250. So again, most people would have thought that up 50, down 50, up 50, down 50 is 0% flat. And most of those people, again, not most, all of those people would be 100% wrong. This is why I'm privileged to have you as my audience, and I hope you feel like you've learned something already so far, because that's a huge thing to understand. So the reality is this: a 25% loss has to be followed by a 33% gain just to be even. A 33% loss has to be followed by a 50% gain just to be even. And a 50% loss would have to be followed by a 100% gain just to be even. That is the facts. That is the math. Okay. So we need to be clear on that and understand why that is not true. All right. So next, let's look at a time period that is real for a lot of us, which is the 2000s. Okay. So starting in 2000, this is the S&P 500 returns, right? This is what the S&P 500 performed as from the year 2000 to 2020. So starting in 2000, you can see it was up 8.97%. And then 2001, down 204, down 17.26, and so on. All right. So a person who had money in the stock market at this time would have experienced this roller coaster, this ups and downs, right? Whereas if someone had put that money in 2000 in an IUL, and in this example, the same time period, we're using a hypothetical here that this person had an IUL with a cap rate of 11%. So let me quickly break down what a cap rate is. What an IUL does is says, hey, you'll be able to participate in the market by having your account linked to an index, most commonly S&P 500, right? It's the most popular one. It's the top 500 stocks in the market. It makes sense to use that as an option. What they say is that you can have the benefits of this index up to a cap. So in this example, I'm using a cap, I'm using a cap of 11%. Right now, today in 2025, if you're watching this video, The carrier that I use, my carrier of choice, I use multiple carriers depending on my client situation, but my carrier of choice has a 12% cap. So it can even be higher than 11%. So 11% is that's a common one, conservative. It's a good example to use. But this is in this example, this person has a 0% floor and an 11% cap rate, meaning when the market goes down, they experience no losses, their account stays at zero. And as the market goes up, they get up to 11% of the value. So again, remember that last slide where that person had to go through pretty much hell with the rapid losses and not getting enough gains the whole time, right? This same person, if they had an IUL, their journey would look a whole lot different. So that first year where they got 8.97% for the S&P in the S&P 500, you can see here that they would share the same result. They both would get 8.97% because remember the cap is 11%. But this is where things go completely different. When those rapid losses start to hit the person that's actively in the market, this person who has an IUL stays flat. Now their account doesn't go to zero. This is what the increase would be. The increase would be zero. Now, wouldn't you take zero over negative 10? I know you would. The market underperformed again in 2002. But guess what? This person didn't lose a dime. In 2003, the market hit another downturn. But guess what? This person didn't miss a dime out of their account. They're living comfortably. When the market recovers, guess what happens? They are able to get 11% of that market gain. But remember a few slides back, they don't have to recover those losses that was just there for the last few years. This person is truly, truly gaining 11%. And then the market performs at 4.43. And guess what? We get the same thing. Then 8.36, we get the same thing. But then the market overperforms and we get up to 11%. And so on. So as you can see here, wouldn't you want the experience of never having to worry about losing all your money? I know you do. I know you do. And I'm going to show you exactly how that money would have performed comparing it. Now that you understand the mind, the behaviors behind it, let's look at exactly how it would perform. So if someone had $330,000 in their account in 2000, you can see here that this person that was in the S&P 500 would, again, go through hell because they would have experienced so much market volatility. And you can see they got the down, they got the up, it goes right back down again, and they're just striving to get back, right? They would end up with $844,208 if that money sat there. Now, is it more than $330,000? Absolutely. Absolutely it is. But what if you could have experienced the same time frame, same dollars, and had no missed sleep, you had complete peace of mind, and you put your money in an IUL? Your money would have stair-stepped all the way to that same time period, and it would have been $1.3 million. So again, would you want stress-free growth, or would you want hell and back? I think you would want stress-free growth. On top of that, you would nearly get $500,000 more. It's really not even it's really a no-brainer. I'm gonna be honest with you. There's 3 strengths of indexing. Number 1, you do not lose when the market goes down. Number 2, point-to-point locked-in gains. So from the time that your IOL is started and the annual usage of an IUL, you're locked in. They can't be like, oh, well, we're going to change this up on you. No, it's locked in. whatever it is, whatever index you're linked to, that's exactly what you get. You get the performance is locked in, guaranteed. And you have the ability, this is more of an advanced strategy. You can set it and forget it and never touch it, right? That's perfectly fine. But what you can do, especially if you work with me, we do annual reviews of your IUL. So we would be able to assess it and move you into different indexes, depending on what the economy is performing at. So you have the ability to reset. You can say, I want to be in S&P this year. I want to go to this, Morgan Stanley, whatever the one. And you look at the components of each index and you can move it around. So these three strengths are absolutely key, right? You never have to worry about these things. So why does it work? Okay, we're going to talk about that. The answers, this is not something Moses came up with. I wish I could take I wish I could take credit for it, but it really has been in place for decades, right? And it's really three IRS tax laws that's in place that makes this possible. The first one is Tax Code 101A, which allows for an insurance contract to have a death benefit, which is 100% tax-free. Now, why would the government want a death benefit to be tax-free? The answer is kind of simple. Essentially, if someone passes away that was a breadwinner and this person has beneficiaries, it could be a spouse, it could be children, the government would prefer that money go 100% tax-free to those beneficiaries because they don't want the burden of having to take care of orphan children or widowed spouse or things like that. So it just makes sense to make that benefit tax-free so that those people can hopefully sustain themselves. That's exactly what it is. 72E is a provision in the tax code that affords monies that are within a life insurance policy to grow tax-free. Why? Because still the same benefits. They want the money to grow to sustain a family if someone were to pass away. And then the last one is 7702, which gives you the ability to access the money via policy loans tax-free. Not withdrawals, policy loans. And, again, more and more information based off your situation, we can explain that, but you want to actually access the money through a policy loan, keep the money inside the policy, whereas the policy grows at a rate of, say, 7%, but your loan might be 4.5% or 5%. So if you take money out at 7%, well, let's say this, you take any money out at 5%, but you're making 7% on your money, are you really paying for the loan? Let me slow that down. If I go to you and I say, you can borrow money from me, I'll give you a loan, and you pay me 5% on that money, but you can take that same money and lend it to John and he'll pay you 7%. Are you really paying me anything? No, you netted 2%. So that's exactly how it works. So don't let the policy loan that you have to take out of your policy freak you out, because you're going to grow money within your policy that will offset the charges that you would incur from accessing the money. Okay, so that's key. These are the provisions. These are not the Moses provisions. It's not the Seed and Shield financial provisions. This is IRS locked, stamped, sealed provisions that allow anyone to access their money that way. So this type of insurance policy can be compared to owning an apartment building or running your own business, right? So some of you, again, watching this might know me as Moses the Mentor, and I am a real estate investor as well. So this analogy, it hits home for me as well, and hopefully it does for you. So if you owned a 5-unit apartment building, right? The way you make money on this apartment building would be if you had tenants. So what happens is, once we identify your bucket, how much money you actually have that goes into your policy, we typically have to break down those monies into 5 portions, 5 contributions, So over 5 years, we need to fund your policy to make sure it's maximum funded. So I use this example, I actually borrowed this example from my mentor, Doug Andrew, where if you have a 5-story building and you only rent one, I mean, it's not a maximum funded, apartment building. You have a lot of vacancy. So you structure your IUL in a way that whatever your bucket is, let's just say your bucket is $500,000 that you want to move into an IUL, you will structure it in a way where it can accommodate $500,000. And to do so, you have to have a certain amount of insurance to accommodate that. So making sure that your bucket is max funded is key. Because if you have an apartment building that can accommodate 5 apartments, but you only rent 3, there's 2 or 40% that's not being utilized. So when you work with me, we not only get you an IUL, we make sure it's a maximum funded IUL. So if you know someone that has an IUL, it's a good chance it's not structured the right way. I would love to talk to you, review your policy, and make sure it's done correctly, because it's a lot of characters out there that don't even know how to do so, right? They might be licensed, but again, they're selling term policies, whole life policies. I'm an IUL specialist. I am an expert at IUL. So I can make sure that it's structured the right way so it's maximum funded, so you can actually get the greatest benefits from your IUL policy, right? So making sure your account is max funded is compared to having an apartment building and it's fully occupied, which will give you what? Money, right? So we talked about, again, the IRS tax code, TEFRA, DEFRA, and TAMRA, which are all related here, to make sure that where people say, well, how does this happen? This is too good to be true. It's not too good to be true. Again, it's been decades since this has been going on. The problem is that many people don't know about it. And it's really right there in plain language for people to embrace it and jump on the bandwagon, right? So let's talk about insurability, because again, this all stems from you having to contribute this money and put it in an insurance policy. So I have clients that are different ages, right? So let's look at this example. So if someone is 35 years old, 55 years old, or 75 years old, you can be a client of mine and I can help you, right? Now, but there's those tax laws pretty much have to add up. And it's not an easy way to describe it, but it essentially says that, based on your age, based off your gender, and based off your health, for whatever that bucket size is, we need to make sure you have a certain amount of insurance that can accommodate your policy. So in this example right here, $1 million policy can be afforded to someone who's 35, 55, and 75, right? But someone who is 35 years old in this example, their bucket would be $215,000. So they would come to me and say, hey, Moses, I really want to, put $215,000 into my policy over those first 5 years, the guideline single premium. And what I would tell them is like, okay, great. We would need $1 million policy to satisfy that. That's pretty much how that would work, right? Whereas the person that's 55, they can contribute more into their policy to get $1 million overall. And then obviously someone who's 75 years old can have even more premiums that they can put into the policy, because what happens is this gray area is the risk to the insurance company. Because if this 35-year-old were to pass away prematurely at 35, which is really young, if they were to get this policy and they passed away at 35, they would get $1 million that would go to their family, right? So the insurance company would be on the hook for $785,000. Whereas if someone who's 75 years old, they are contributing monies to this policy, but the majority of that is their money. They're self-insuring themselves for the most part. And this $740,000 could be a strategic rollout that this person might have in an IRA somewhere, and they would say, hey, Moses, I would love to move my money into an IUL where I can access it tax-free, penalty-free, and I can also give it to my beneficiaries with no issues, tax-free as well. So this is just to illustrate that there's a solution for any person at any age. Don't let age, or you're never too young or too old. Give me the opportunity to have a conversation with you, and I can break this down for your situation. Okay. So for this one right here, now let's look at, let's just say across the board, each person at 35, 55, and 75, they all have $500,000 to move into an IUL. Okay. So the person that is 75 years old, they have the 500,000. What would happen is, once they are self-insured, at that point, their premium, the insurance risk would only be 190. So this is just a reverse way to look at it. So it'd be 190,000. This 55-year-old would be able to get an additional 715,000 of protection from the insurance company. And then the person who's 35, we're really raking in the dough at that point, they can actually get $1.8 million of insurance on top of what they have. But again, over time, the goal of an IUL is to have as little of insurance risk as possible, because then your cost for insurance is as low as possible. So you can all look at this in different viewpoints. This person right here is paying less or actually equal to the same amount of insurance. A 75-year-old is paying $190,000 in insurance, is paying nearly, the same thing as someone paying 1.85 for a 35-year-old. So again, the goal of an IUL is for living benefits. The death benefit is just the icing on the cake. The goal here is to have $500,000 that you can access tax-free at your own, and grow it tax-free as well. That's the goal. And this right here is just a snapshot of someone who's of those same age groups growing that 500,000 over time. So from year 1 to year 25, this again is to show that there's parity across age groups. Don't think you're too old to participate into this. Don't think you don't have enough time to do it. The key is that when you're older, typically older people have more resources, more money. Again, we can put that money to good use, and you don't need to worry about, oh, I don't have 50 years for it to grow. Don't worry about that part. I'll take care of you. So we can make sure everything is fine. It just has to be structured the right way. The greatest thing about a life insurance policy, which helps it currently be tax-free, and 99.9% that it will be tax-free, is that life insurance policies are not investments. The moment you start designating something as an investment, that's the moment that the IRS will come knocking for tax revenue. We do not want life insurance to be called an investment, okay? So it is not an investment. So if you reach out to me and say, hey, I want to invest in an IUL, I'm going to tell you it is not an investment. We don't do investments. We provide clarity and set up max funded IULs to make sure you don't have to worry about investments going haywire. You can use a portion of your money for that, but IUL is all about making sure you have guaranteed consistent income when you need it, how you want it, and you can pass it on to your beneficiaries when you're gone, and they don't have to worry about taxes as well. Okay. So how you actually set this up, again, it's the bucket. So when you and I meet, we would determine what your bucket is. We would determine what is the maximum you want to actually move into your policy over the first 5 years. It's typically 5 years. It's something called the guideline single premium, which is a 5-year period. It could be 4 years, 8 months, 5 years, 2 months. It all depends on your age and your sex and your health. But generally 5 years, right? We figure out that bucket, and the cash is coming in, your interest is coming in, and the bucket fills up, right? And this is all corresponding and making sure that we're satisfying the TEFRA, DEFRA, and TAMRA tax laws, so we don't violate the insurance policy, because if you violate the insurance policy and you overfund it, it will then turn into an investment and it will be taxable. So we have to make sure we do it in the right way, in the right structure. So what happens is we put the cash contributions in, it's growing. And then this little spigot out of the bucket is simply the cost of insurance, right? But the spigot that's coming out of the bucket is much smaller than the actual faucets bringing the cash and the compounding interest in there. So there's a cost to have the money in there so we can preserve that peace of mind, but it never outshines the amount of cash and compounding interest that will keep the bucket full. So the way it works, again, we break your bucket amount over 5 years. The reason why you can't just put it all in there is because, people would take advantage for that. People would, pour, millions of dollars in there and hide it from the government. Again, it's not an investment. It's not money laundering. It's to make sure it's within the confines of an insurance policy that's protected by TAMRA, DEFRA, and TAMRA and TEFRA. So we have to make sure we structure it correctly to do so. So it has to be structured over 5 years. Let's just say $100,000. We would put 20,000 year one, 20,000 year two, year three, year four. Now your bucket is full. You have a maximum funded IUL. Now, does that mean you don't need to contribute to it anymore? It all depends. If you are in retirement, no, you don't want to contribute anymore after that. You don't have to. You want to enjoy the benefits of your dollar amounts. If you are 35 years old, yes, more than likely you're still working. So then we shift gears to a different approach. We focus on filling the bucket the first 5 years, and then we focus on maximum funding it every year after. So, for example, your bucket might be 100,000. You're at 100,000 after year 5, but then there's a guideline level premium that tells you this is the most you can put in every year. And your yearly maximum, let's say, for example, is 10,000. So I would instruct you to say, hey, we have 100,000 in there, and then 10,000 you need to contribute up into whatever year you would want to retire. And then at that point, we would cut it off and we would move the policy from an increasing death benefit to a level death benefit, and you would then start taking money out of the policy. Okay. Now, the other cool part about that part I just told you about is that unlike an IRA where you kind of lose your contribution, you can put 7,000 in there, and if you don't put 7,000 in a year, it doesn't carry over. That doesn't work for an IUL. Whatever that maximum is you can put in yearly, if you were to only put half of that other amount you can continue to carry over. That's the cool part. It's ultimate flexibility with an IUL, and that's why I love it. So just to refresh your memory, there's 3 opportunities, the greatest opportunities. Oh, went back too far. The 3 greatest opportunities for an IUL is that it's a tax-free vehicle. It's linked to inflation. So as the market goes up and stuff like that, I mean, your account is going to go up to be able to combat inflation. So you're okay. And it's indexing you to safety. You will never go backwards on your account. That's unbelievable. And these strengths lead you to these top 3 strengths here. You have liquidity. You can access the money anytime you want to. You have the safety of principal, so you're never losing that, again, not going backwards. And then you get a great rate of return. And more importantly, sequence of return. If you remember that S&P slide where it was going down and up, down and up, down and up, and how you need, for a 25% loss, you need a 33% gain. You don't have to worry about that. Like, it's a true rate of return because you never lose money. So what's next? For you, I hope the obvious, hands down, next step action is to book an appointment with me, right? Directly with me. So you'll find a link in this description, in the chat. You'll be able to book an appointment with me, pick a time that works for you. There's no obligation, there's no cost. You can also go to my website, seedandshieldfinancial.com. You can check us out. And also, if you book an appointment with me, that would be I'll be extremely grateful. I think it'd be a great use of your time. You'll also receive a free tax-free retirement training courtesy of my mentor, Mr. Doug Andrew, who's the best-selling author of the book, The Laser Fund. So once you actually sign up for your free financial consult with me, I'll go ahead and grant you access, and you'll be able to have that lifetime at no additional cost. Also, if you would like to purchase my book, it's called Tax Free Freedom. It's on Amazon. So again, hopefully this information was valuable for you. The next steps is on you. Let's go ahead and talk directly, and I can break down your situation. It doesn't matter how old you are. Let's just figure it out, and let's get you out of these tax deferred accounts and move you into something that is structured to optimize you financially at any stage of your life. All right. Look forward to talking to you soon.